227,548 American homes were hit with foreclosure filings in the first 6 months of 2026. A 21% spike in a single year, according to Adam Data Solutions. And ABC News just confirmed who's getting hit hardest. It's not longtime owners. It's the people who bought in 2022. That's right. Foreclosures are surging 21%. And ABC News is warning that recent buyers are the ones next in line. The investigative team analyzed the Adam data and found filings aren't just up 21% from last year. They're up 28% from 2024. And they've climbed 71% since 2020. So stick with us because we're going to show you two things in this video. Number one, we're going to show you the one government loan program that's behind more than 80% of this entire surge, because this distress is not spread evenly across the market. And once you know where it's concentrated, you know exactly which neighborhoods are exposed. Maybe even yours. Number two, we're going to name the 5 markets where this distress is already handing buyers and investors their biggest discounts since 2018, including markets where the majority of recent buyers are now underwater on their homes. Let's get into the data. Let me start with what actually happened in the first half of 2026, because the details here matter. According to Adam Data Solutions' mid-year 2026 foreclosure market report, those 227,548 properties with filings work out to 1 in every 632 housing units in America. Foreclosure starts, the beginning of the process, at 164,566, up 18% from a year ago. And completed foreclosures, where the bank actually takes the home back, hit 27,983. That's up 33% in a single year. Think about that. Banks are repossessing homes a third faster than they were 12 months ago. And here's a detail almost nobody is talking about. The average time to foreclose in the second quarter was 563 days, the shortest timeline since 2013. The pipeline isn't just filling up, it's moving faster. And this didn't start in January. Adam's year-end report shows 367,460 properties had filings in 2025, up 14% from 2024. December 2025 alone saw filings jump 57% from the year before. Every quarter, the number gets bigger. So why is this happening, and why is it hitting 2022 buyers specifically? It comes down to the affordability math those buyers accepted. According to the Urban Institute's Housing Finance Policy Center, using loan-level data from Intercontinental Exchange Mortgage Technology, the median debt-to-income ratio on purchase mortgages ran about 42% in late 2024, and roughly 46% on FHA loans. Nearly half of gross income committed to debt payments. Let me make that tangible. Say you bought a $400,000 house in mid-2022 with an FHA loan. 3.5% down, a 6.5% rate. With upfront mortgage insurance financed in, you're borrowing $392,755, and your principal and interest payments is $2,482 a month. The same loan at 2021's 3% rate, $1,656. That's $826 more every single month, over $9,000 a year, before property taxes and insurance, which have also exploded. Buyers accepted that math because they believed prices only go up. There was no margin for anything going wrong. And ABC News just put a face on what happens when something does go wrong. Emily Arner, a flight attendant and mother of 3, bought her family's home in Chandler, Arizona, a Phoenix suburb, in early 2022. Then her husband lost his job. In her words, "My husband's job was great and we could afford it, but once he lost his job, it was this huge mortgage payment, and we had no way to cover it. They tried everything. They lost the home to foreclosure in September 2025 and now rent a mile away." Her warning to the rest of the country: if you don't have savings or a way to cover yourself, it absolutely can happen to you. It can happen to anybody. Which brings me to the first thing I promised you. The one loan program driving this. It's the FHA program. The government-backed low down payment loans that first-time buyers used to stretch into homes at peak prices. The April 2026 Mortgage Monitor from Intercontinental Exchange Mortgage Technology found 878,000 mortgages were seriously delinquent or in foreclosure as of late February. up 175,000 in just 4 months. That's a 25% jump, and excluding the pandemic spike, it's the highest level since June 2018. And here's the concentration. FHA loans accounted for more than 80% of that entire increase, with seriously past due FHA volumes up more than 40% over that span. By May, FHA loans made up a record 55% of all seriously past due mortgages in America. The Mortgage Bankers Association confirms it from a completely separate survey. FHA delinquency hit 11.52% in the fourth quarter of 2025, the highest since 2021, and climbed again to 11.88% in the first quarter of 2026. And for context on how stretched that is, FHA delinquency peaked at 13.3% in 2010, in the depths of the great financial crisis. On this one slice of the market, we're within shouting distance of that level right now. The Mortgage Bankers Association's Marina Walsh names the stressors plainly: a softer labor market, other personal debt obligations, and rising taxes, homeowners insurance, and fees. Now, connect that to the title of this video. Intercontinental Exchange Mortgage Technology's May data shows loans originated after the 2022 rate hikes made up 39% of foreclosure starts, 34% of active foreclosure inventory, and 43% of completed foreclosure sales. The newest mortgages in the country are failing first. That has essentially never been the pattern in modern housing data, and it's exactly what ABC News is warning about. Real quick, if this market intel is helping you make better decisions, hit that notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. Now, here's where I'm going to go further than the mainstream coverage, and here's the really alarming part. Washington knows this is coming, and its own documents say the numbers get worse before they get better. On April 15, 2025, HUD published Mortgagee Letter 2025-12, which terminated the COVID-era loss mitigation options that had been keeping struggling FHA borrowers out of foreclosure for 5 years. Those protections expired on September 30, 2025, and in FHA's own fiscal year 2025 report to Congress on the Mutual Mortgage Insurance Fund, the agency forecasts, their words, a short-term increase in default and claim rates as those borrowers cycle through the new system. The Mortgage Bankers Association's Marina Walsh directly tied the first quarter delinquency jump to that expiration. So our controversial take, anchored entirely to federal documents, this foreclosure surge is partly engineered. The safety net was removed on a schedule. The government wrote down in advance that defaults would rise, and that's precisely what's showing up in the data. So where is this hitting? Florida has the worst foreclosure rate in America, 0.27% of all housing units, 1 in every 373 homes, with 27,494 filings in the first half, up 33% year over year. South Carolina is second at 0.26%, then Indiana, Delaware, and Illinois. By raw foreclosure starts, Texas leads at 20,739, then Florida at 20,358, and California at 16,040. In fact, ABC's zip code analysis found the single highest foreclosure count in the entire country in zip code 77327, rural Liberty County, Texas, northeast of Houston, which tells you this is not just a coastal Florida story. And the fastest growing states tell you where this is headed next. Idaho starts up 59%, California up 57%, Georgia up 52%, North Carolina up 47%. At the metro level, Punta Gorda, Florida posted the single worst rate in the nation at 0.5%, and Lakeland, Florida was the worst large metro at 1 in every 421 homes. And Realtor.com just confirmed the mechanism spreading underneath. Short sales, where the lender agrees to accept less than the mortgage balance, are making a comeback, up roughly 16% year over year in the first quarter of 2026. With Lakeland carrying the highest short sale share in America at 6.7% of listings. A Lakeland agent told Realtor.com exactly who these sellers are. Those homeowners that purchased in 2021 through 2023 are most of the people in trouble. They overpaid for their homes. And that's the second thing I promised you, because one person's short sale is another person's opportunity. Here are the 5 markets where the distress is deepest and the discounts are forming fastest. The Central Florida corridor from Lakeland down through Punta Gorda and Cape Coral. Then Austin, Denver, Phoenix, and San Antonio. Here's why. Intercontinental Exchange Mortgage Technologies analysis found roughly 70% of 2023 and 2024 FHA borrowers in Cape Coral are underwater. In Austin, 65% of the 2022 vintage is underwater. Nationally, Cotality, formerly CoreLogic, reports 1.24 million homes, 2.2% of mortgaged properties, are now worth less than their loan, up 21% in a year, with recent buyers losing an average of $13,400 in equity and Florida owners losing $37,400 on average. Tappable equity per borrower is down 38% from its peak in Austin, and 1 in 4 seriously delinquent loans nationwide would be underwater at distressed sale prices, which means these sellers can't simply sell their way out at full price. That's what forces short sales, deep cuts, and in the hardest hit vintages, losses relative to 2022 purchase prices. Meanwhile, the rent side of the ledger is cracking in the same cities. Zillow's data shows the typical national asking rent at $1,965, with growth stuck at just 2.2%, and rents outright falling 3% in Austin, 2.3% in San Antonio, 1.8% in Denver, and 1.3% in Phoenix, with nearly 2 in 5 rental listings nationwide offering concessions, a record, and Denver hitting 65.9%. If you rent in these markets, you have more negotiating leverage than at any point since this data has been tracked. And if you've been waiting to buy, falling rents plus distressed inventory is shifting the buy versus rent math for the first time since 2018. Now, is this 2008 all over again? No. And I want to show you why, because the difference is the whole story. In 2010, 2,871,891 properties had foreclosure filings, and banks repossessed over 1,050,000 homes. Last year's totals are down 87% and 96% from those peaks. At the end of 2009, 26% of mortgaged homes were underwater. Today, it's 2.2%. Resi Club Analytics puts the total mortgage distress at roughly 2.9% of loans today versus 11.5% at the 2009 peak. 2008 was a system-wide credit failure. 2026 is a concentrated affordability failure. One loan program, 3 buying years, and a specific list of metros. Even Adam's CEO calls it market recalibration rather than widespread distress. But here's the kicker. Concentrated failure still resets prices, because in the neighborhoods where FHA buyers clustered in 2022 and 23, the short sales become the comps for everyone. So let me bring this home for each of you. If you're a homeowner who bought before 2021, you're sitting on a serious equity cushion. This is not your crisis, but watch your local comps of recent construction sold heavily on FHA loans. If you bought in 2022 or 23 in one of these 5 markets, know your number. And if the payment is slipping, call your servicer early. The new rules move faster than the old ones. If you're a seller in these markets, price ahead of distressed comp, because Colorado starts are up 57%, and every month of waiting adds another short sale to your competition. If you're a buyer or investor, patience is finally paying. Track short sale share, underwater vintages, and concessions, because the decisions you make in the next 12 months could save you tens of thousands of dollars. And if you're a renter, negotiate. 2 in 5 listings are offering you something. Bookmark this video, come back in 6 months, and check every single number I just showed you against the new data. That's how confident we are in these sources. And if you want to be first to see where these numbers go next, make sure that bell is on. We'll see you in the next one.